Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today it's a review of a position I've held in the Crassus investment portfolio for quite some time. We're giving you an update on the GEO group. You can go back and see previous videos outlining the initial thesis. Today we're going to review how things are playing out. Are they playing out as I expected? What am I doing with this stock in the portfolio, and what I expect moving forward into the future? So without further ado, let's move on. A quick plug to the sponsors. This video is sponsored by my premium Substack publication, The Options Mavericks. It's a part of my portfolio that I have carved off to create income for myself, usually by way of selling options. So if you want to check that out, year to date, we're up a lot of money, and that's great. So hit the subscribe button if you're interested in learning more about how I do that with options. There's a link in the description, and you can check that out without me spending all day plugging it. Okay, guys, disclaimer, of course, housekeeping. Nothing I say here is intended, nor does it constitute financial advice. It's just my opinion. Some crazy guy putting his thoughts out to the world, and you are very kind enough to listen. So please make sure you seek someone who is appropriate to give you personalized financial advice. That is not me. This is not advice. Nothing is to be construed as such. So that's out of the way. And if you want to look at the portfolio that I'm talking about today, you can check it out with this link in the description to eToro, and you can simply add to a watch list. Or if you've got funds and you want to copy what I do and have me do the work for you, then there's that option available. Currently up 16% on the year to date. So far, so good. Literally just checked that before. So moving into the key thesis, GEO Group, who are they? What do they do? What's the thesis in a nutshell? So they're the first fully integrated REIT for prison systems. This is the old slide. That's important because they're no longer a REIT. They have changed to a C corporation, and I'm going to explain why that's a big deal. These are the number of beds they've got. They have a big footprint, if you want to think of it that way, in terms of their infrastructure. They did have a large debt load, and they've been paying that down. They had a lot of assets. The market didn't like it because of the debt load. In a nutshell, that's where it was. So the question was always, what's their survivability, their liquidity, and what will be the catalyst to unlock the value that's in those assets? So to unlock the value of those hard assets, the market was really wanting to see that they could pay down their debt. And we're going to see, did they or did they not? How are things tracking? I've got quite a few great graphics for you. Asset valuation, I've just tweaked this as of before because they've paid down a lot of about $1 billion worth of their liabilities, and that goes straight to the asset valuation. So if you look at this cost of reconstruction at 30 cents on the dollar, okay, we're calling it 4.5 bill. And then we're minusing the liabilities. So previously, if you look in the other video, it will say 3.5 billion. They've since paid that down over the year. Not too bad. Giving you a very rough back of the envelope asset valuation of 3.23 billion divided by their shares on issues, which have been updated. It's roughly $26.47 if you assume a 30 cent on the dollar valuation for their existing infrastructure. Moving forwards, catalysts and consideration. So this is all well and good, but that can sit there for years on end, and no one will care about it unless it can change the balance sheet and start generating cash to shareholders, generally speaking. Instead of it being a REIT where it has to pay out, I believe, up to 80% of its free funds flow from operations. Any real estate guys can correct me in the comments section. Now what's happened is, as of December 21, they're no longer a REIT. They decided to change corporate structure. I think it was a good decision. Those people that were just wanting the divvies, maybe short-sightedly, weren't happy about that. But the whole idea is that the balance sheet wasn't right, and they needed to pay that down. And the way to do that made sense, in my opinion, at least, to become a C Corp so that they could take that free cash flow and use it to rapidly pay down debt. So by lightening the debt load with consistent free cash flow, I do believe we're starting to see the market warm up to this particular company, and it will, in theory, and very likely, give it a higher re-rating. So I don't have to hang my hat on that. I just have to know that, okay, this is what the asset valuation is. I think I can get a lot of that unlocked if the balance sheet improves. And if the market is sleeping on it in terms of giving it the multiple evaluation, at least I'll have a ton of free cash coming through to me, given the contractual nature of the cash flows of this business, very consistent cash flows. So I have tried to apply this theory before, not always so successfully. I tried it with Warner Brothers, and I just think I got the timing wrong with that. It still has a pretty ordinary balance sheet, in my opinion, and I didn't do very well out of that at all. So I took a hit on Warner Brothers. The idea was the same; they could pay down the debt, and that free cash would be rewarded by the market. Um, I just think it's a harder industry now, lot more competition than most people thought. In any case, the point is, I need to ask and answer the question: are they doing this successfully? Are they taking that free cash and are they paying down the debt? So I've got quite a few slides here to hopefully answer that. So here's December of 2021 when they changed structures. So let's take a look. In the gray is the total liabilities, and then in the blue is the long-term debt. And as you can see, they've been able to reduce that by roughly $1 billion in terms of the long-term liabilities. As far as I'm concerned, that's very, very good. The long-term debt, again, very similar structure. So if you think about them paying down the principal on that debt, they're saving interest, which will improve, all else being equal, the earnings dropping further and further down to the bottom line, and they'll be able to take that and rapidly compound their ability to pay down the debt. That should be the idea. That is the idea. And so far, it appears to be playing out as far as I can see. Measures here: net debt divided by EBITDA minus Capex. They're just doing a straight EBITDA is a bit misleading because you have to spend money on your business just to keep it maintained. That's the Capex. This business doesn't have a hell of a lot of Capex, really. So if we take a look, I've gone back a bit further from 16 to 2022 is the most recent I could get. If you look at the debt metrics, they were pretty high going back in the day. But in what appears to be quite a quick period of time, they've been able to take that net debt and reduce it quite a lot. Their total debt has reduced, and then their net debt as a straight fraction of their EBITDA is also reduced. So we're getting close. You guys that have been following me for a while know any kind of credit analyst will look at a net debt to EBITDA of more than 3. They start to get a bit iffy. Given the contractual nature of this business, I looked at it and said, hey, these revenues are generally quite stable. If they can change the structure and have that free cash flow pay down the debt, how quickly can they do that? Because after that, it's going to be all jam and donuts back to the shareholder. Long-term debt, liabilities, and then debt to equity as a percentage is mainly what we're looking at on this chart here. Okay, so no need to complicate it really. Here's the starting point of their change of corporate structure in December of 2021. They've got the older 3 times debt to equity, making the old credit analysts start to get a bit nervous, I would have thought. But they've done a very good job, as you can see here, reducing that basically half of where it was only 2 years earlier. So they should continue to do that as the years roll on, and before too long, they can retire all that debt and start dishing that cash back via share buybacks or divvies. Everyone loves a divvy. So total shares, book value per share, and then tangible book value per share. What's the difference? Tangible book value basically strikes a line through all the intellectual property, the goodwill, the sort of airy-fairy things that can be counted as assets. But in an economic downturn, I'd imagine they'd be pretty difficult to sell. So worthwhile looking at the two. Shares at the top haven't really changed too much, which is good. We don't want to be diluted. I have been stung by that in the old, shall we say, Greek maritime industry in the past. So I learned my lesson there. Book value per share here has been growing, very nice. And if we look recently, get this out of the way, again, from that fateful date at the end of December in 2021, that tangible book value per share as an asset value has been growing at quite a rapid rate. That little pink bar column that's steadily growing down the bottom there. That's what I'm interested in. So those metrics are lining up with the thesis, and I think it's starting to, the share price has risen since I first covered it quite a bit, but it's actually a more attractive proposition to me now, given the way that management have executed. So the return on assets looks pretty ordinary. The return on equity looks pretty ordinary. The return on invested capital is okay, I guess, considering the industry that it's in. We're interested down here in unlocking, well, I'm interested in unlocking this valuation and this metric here, market cap to free cash flow. If I can get a, here a 33 to 25% free cash flow yield, I'm pretty happy, provided I'm confident the management are going to do the right thing with it, and seems to be the case. Did reach a 52 high of $12. I think it can easily be back there. Don't know when, but if they keep paying down debt, so much the better. This might turn out to be a stock that people rush back into when their balance sheet is cleaned up, because people will be searching for yield, potentially. We'll see. I guess it all depends on what happens with risk-free rates, etc. So if we look at valuations, a bit tricky to, or the multiples, what multiples am I going to put on my estimates of their earnings and cash flows, etc. And the means here all look pretty damn high to me. So, tangible book value per share, this is where it's been at. The EV to EBITDA, 10. I'd be a little cautious using 10 and using a 13 for the PE. Why? Because I believe we're going to go back to a broad market environment where, as interest rates rise, when you look at previous cycles in history where interest rates were at certain levels, and you take the PE, where I think we're going back to this broad sector of maybe a 12 to 14 PE environment for, say, the S&P 500. Could be wrong, depends on what the Fed does, but I've learned my lesson in not being overly generous in the multiples with which I use to value a business. And because when times are tough, the buyer just is not going to give you that multiple. It's just for me. People may or may not agree with that. When I look back at buying private businesses, the best experiences I had was when I was just absolutely dirt cheap on the multiple I paid. It forgave so many issues, so many boo-boos on my behalf, or just in the broad economic environment, that it's definitely a lesson that stuck with me. So if we look at the one page back of the envelope valuation, looking out for 2024, current price 7.32, tangible book, EBITDA per share, and then earnings per share, and I've applied a multiple to that. And you can obviously go through and do the same and adjust with a multiple that you believe is appropriate. If we take the prices here calculated, give it an equally weighted average, we're fairly consistent. We're coming in at $22.23. Doesn't mean I think the market will unlock that or realize that value or be willing to pay that by 2024, but it just gives me a bit of a goalpost, at least in my mind. So at the moment, if I were to buy more shares today and everything were to play out as I've listed here, that's to almost a 3x. Okay, 275% on the upside, which is obviously a very decent margin of safety. Timing, of course, is always the tricky part. So if we extend things out a little bit further, what cash flows or earnings can this thing produce at what rate compounded? Those things are always tricky. Using the company's weighted average, working average cost of capital as a discount rate, 9%, that might be a little bit low in terms of discount rate. If we move into a higher interest rate environment, who's to say? I will need to adjust accordingly. So just something to be aware of. It's not static. It can change at any time. And some people might not even dream of using less than a double-digit discount rate at the moment. If you've got treasuries paying you 5% and you want, I don't know, a 7% equity risk premium, you wouldn't use anything less than a 12. I'm just using weighted average cost of capital, and the rest is up to you. I do a base case, a bull case, and a bear case in this scenario, base, bull, and bear, with its a probability that's completely a guess. It's arbitrary. You can change that depending if you're more bullish or more bearish. And then summing up those present values for the EBITDA per share, the free cash flow, the earnings per share, I get an average estimate of its valuation at around 28.85 for those earnings and cash flows. So again, fairly consistent. And then if I were to take a 2/3 margin of safety on that, I would want to pay no more than $19 for the share as of today, given it's trading at $7 and a bit. Obviously, there's a huge margin of safety. So we've looked at an asset valuation. We've looked at a cash flow valuation out into the future. If we look at their ability over a shorter period of time, if we look at their earnings and then we add back what I think is going to be their expenses in certain aspects, we get a valuation somewhere around $37. Again, these are just assumptions to say what happens if more of that free cash continues to pay down the balance sheet. So different ways of looking at it. I hope you guys enjoyed that. In summary, I guess the hammer comes down. What's my verdict? What am I doing with it? It's currently trading at around 2.9% of the portfolio. I would like to allocate a little bit more. I believe over the long term, any real estate play is really, really handy. I've looked at other plays out there. I find them tricky to value personally. And so I would like to build this to a 3 to 5% position. If we get a really nasty sell-off, I may even increase that to 6 or 7. In summary, it's got a margin of safety in terms of its discount to book, discount of future free cash flows. Debt retirement is a catalyst to unlock the underlying net asset value. Management have delivered on that so far, and we can see that in the reporting. The free cash flow is fairly stable given just the nature of the revenues of this business, and it's available at a high yield, trading at a discount to its valuation. So that's the way I look at this company. That's why it's in a portfolio that everyone can see. And I also trade options around it. The options usually around the monthly for GEO, and we've had decent volatility, decent results. So that's that, guys. Take care. I hope you enjoy it. Leave your comments in the description. Make sure that you like and subscribe to the YouTube channel and check out the links in the description if you want to follow more of my work. Otherwise, take care. I look forward to catching up with you in another video shortly. See you guys.